Hello and welcome to KYC, a brand new show at NDTV Profit. And in this fast-paced world of stock markets, investors are bombarded with information. But when they often lack is deep, comprehensive understanding of the companies that they invest in. KYC, Know Your Company, is a show designed to give you regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. And today we have in focus with us Supriya Lifesciences. Now, the reason why we thought it would be a good idea to take this one up is because we've actually seen a lot of traction in terms of its price action of late. In fact, we've also had a conversation with the management of the company a couple of times in the past few months, and we thought it would be a good idea to not only look at the company, but also perhaps discuss the future of the company with the management itself. But as usual, let me start by telling you about what the company does. Well, it is a pharmaceutical major. It has niche products with a basket of around 32 APIs with about 1,700 customers. In the APIs specifically focused in antihistamine, analgesic, also anesthetic, as well as anti-asthmatic and anti-allergic drugs. So, well, it has, the whole gamut of drugs as far as these specific areas are concerned. And it has diversified operations. It has presence in about 128 companies. This is as far as the company is concerned. But what we usually do with all the companies that we address is that we take these companies up and we rate them on a handful of parameters. So, of course, in this case, we're going to talk about, well, the income statement, we're going to talk about the balance sheet, return ratios, cash flows as well. And after that, we take a look at the shareholding, street credentials, the street coverage, though in this case, it isn't much, and of course, the valuation picture too. And of course, to take us through that, we also have with us Varsha Chandnani. She's going to help us out to decipher the company going forward. So, Varsha, thank you for joining in. Let's start by talking about the revenue growth. Because, there's been volatility in terms of revenue and also the consequential impact that the profits have seen. What is your observation here?
Right. So, Agam, if you just analyze the income statement for this company, so revenue for the last 3 years, if you see the CAGR return, it's almost 13%, while EBITDA is flat and margins for FY24 is 31%, and the net profit, if you see on a CAGR basis in the last 3 years, it had been negative. Now, there's a reason for that, because in COVID, if you analyze this company, so there's a huge difference we have seen in this company. So in 2022, in 2021 and 2022, the most contribution was from China. And because China was closed due to COVID, so this company couldn't sell high margin products to China, and this is the reason. If you analyze the numbers in 2021 and 2022, the margins were in pressure. The revenue was not good. This is the reason we are seeing this kind of low growth numbers. But now company has actually been diversified. So they have been shifting from China to regulated markets. So overall, this is the reason why you're seeing, low growth in financial statements. Yeah.
Okay, so it's a neutral rating because of the various challenges that the company is facing. But as far as the balance sheet is concerned, it's well, a pretty steady state here. And that's why we're going to give it a thumbs up, because it has a net worth of about 815 crores. Gross debt stands at a negligible 5 crores, and its cash in books is, well, at a negative 84 crores. But because of the fact that it doesn't have any debt, well, it's not too much of a concern, which is why we're going to give it a thumbs up. But how about the return ratios then, Varsha?
Well, I would give a neutral rating for that as well, Agam. So if you see the ROE and ROCE for 2022, that's quite good. But don't consider this number, because this is a one-off. The company had a very good numbers in 2022. But if you see in 2023, the ROE was 14% and ROCE was 17%. Now, again, the reason for it, because the numbers were not good in 2022 and 2023. This is the reason why we are seeing pressure in ROE and ROCE. In 2024, again, they're back. So if you see return on equity, 16% and ROCE is 21%. Moving forward, if you see numbers, the return ratios may augur well for the company, because they are entering into the new therapeutic areas or, into the new segment, that is CDMO as well, which we are going to talk about later.
All right. And moving on, if you consider, the cash flows too, well, they've been holding out and reasonably well. Well, let's consider the cash flows from operations specifically. In fact, they've seen an improvement, about 113 crores in FY24 and about 64 crores in FY23. Sure, on a net cash flow basis, the number is negative, but we must remember that it's a positive number coming in from cash flows from operations, which is why we'll give this one a thumbs up as well. But it's a well-held company too, right, in terms of shareholding?
Yes, so actually I would give shareholding pattern as a thumbs up. Now why? One is the promoter's shareholding pattern has not changed. This is a good thing because the promoter has a skin in the game. The number two factor is your FIIs, that is foreign investment players. They have actually increased their share. So in 2024, in September 24, it is almost 6% versus if you consider, compare it with June quarter, it was 4.9%. So good uptick when it comes to FIIs number. And even if you see the DIIs, so DIIs numbers is also not changed. So pretty actually a good kind of shareholding pattern this company has.
Right. And, in terms of your street credentials too, a very strong price action on the stock. 5-year performance, about 58%. In fact, in the last 1 year itself, the stock has moved up nearly 3x, so 181% gains there as well. So pretty strong show, so it's thumbs up there. What about valuations, Varsha?
So on the face, Agam, it will look like that Supriya is comparatively, it's present at a good valuation. If you see the FY25 annualized PE is at around 39x. If you compare it with its peers, that is Newland, Divi's and Aarti, so a pretty good comparison to industry peers. But there's one thing here, because if you compare it with Newland, Divi's, these guys are more into CDMO business. Now CDMO business and CMO business typically gets a high PE, a premium PE, versus Supriya will enter into CDMO business now. So maybe the numbers from CDMO business we will see in Q3 onwards. This is the reason that you are seeing 39x P versus 66 and 83x P. Moving forward, if you see, when company will be a fully CDMO player, we can see good uptick in valuation. So on a valuation wise, yes, good number I would actually give.
Okay, so well, it's again a thumbs up there. And in terms of street coverage, we don't have a lot of analysts covering this company, which is why we're going to go with a neutral, though we have one analyst who has in fact a buy here. And that will bring us to a total rating as far as this company is concerned, based on the parameters that we addressed right now. And the total rating in that case comes down to around 6.5 out of 8, which is not a bad rating at all. Do remember that there are no thumbs downs, and we're a handful of neutrals, which is why we've given it a 0.5 point. So that's how things stand. Very quickly, if we can just consider the strengths and weaknesses as well. Strengths, again, facility supporting backward integration for 15 products. It is well in a well-regulated market, but significant export presence, and gets in fact 83% of its revenues from exports. And in terms of weakness, well, I reckon that this is a double-edged sword. So it's not necessarily a weakness, but it does have product concentration. About top 3 products garnering about 43 to 45% in FY24. But what about opportunities and threats, Varsha?
So opportunities, Agam, if you see, the next leg of growth for this company is CDMO business. Everyone is betting on Supriya for CDMO business. One is that. The new products that company is entering into the other opportunity, and they are also expanding their business into the other markets like Brazil and Mexico. Now, when I talk about threat, so regulatory compliance is one of the risks that the company has been facing, and of course, complex, lengthy and high approval in international market is the other threat that the company has.
All right. And finally, Varsha, the outlook for the company?
So pretty good outlook. So if you see, they'll actually ramp up their sales from existing products going into new products, and also CDMO and CMO opportunities with the street, where the street is actually betting on. They expect to grow their top line by 22 to 23% in FY25, with margins at EBITDA margins at around 30 to 32%. They're also focusing on more on regulated markets to file few products in Europe, and they expect 1,000 crores of revenue in next 3 years. And the CDMO business, which street is betting on, is actually expected to contribute 120 to 150 crore in revenue over the next 3 years.
Let's get in the management of Supriya Lifesciences into this conversation now. We have Saloni Wagh. She is the Managing Director at the company. Saloni, good afternoon, and thanks for taking the time out. Saloni, my first question will have to do with your operating margins. Now, from what we understand is that you have about 15 products which have the benefit of backward integration. And about 75% of your revenues come from those 15 products. The other aspect that could potentially be playing out in favor of your margins is that you have a relatively larger exposure to regulated markets. So among these two factors, what is it that's actually keeping the markets much higher? Is it one case which has a higher influence on your better margins as compared to the other?
No, I think both have the equal amount of influence on the margins. The backward integrated model helps us to have a complete grip on the costing because we don't outsource any kind of advanced intermediates. We manufacture right from the basic stage. So we have a very good grip on the costing. And at the same time, more penetration into regulated markets where the average selling price of the products is significantly higher. That goes back to the margin. So at one side, we are actually saving costs. On the other side, we are getting better average selling price. So both are adding back to the margin. So I would say 50-50% to both.
Right. Saloni, hi, Varsha this side. So sticking to the margins, now this recent quarter we had a good uptick in margins. But I suppose I understand that your guidance for the margins has been around 28 to 32%. Are you being more conservative while guiding the margins, or do you think that there's still an uptick in margins in FY25, maybe about 30-31%?
Yes, for FY25, we are expecting an uptick in the margin. We are expecting the margin to be somewhere around 34%. Moving forward, also 32 to 34% margin is something that we are very confident of maintaining. And this is predominantly happening because of more products now moving into more regulated markets. So other than the top 7-8 products, which you referred to a while back, there is a set of about 8-10 products where we have completed the regulatory formalities and we are expecting good penetration into those markets. So definitely, I think the margins would be on a slightly upward trend, and 32 to 34% is something that we are confident maintaining in the long term.
Understood. So 32 to 34%. Now, talking about your revenue. So in your last call, I remember you had mentioned that H2 will actually be better for Supriya than H1. So are you sticking to that thought process, number one? And so what is the revenue? Because you have been guiding that 22 to 23% is the revenue guidance that you have been giving for next 3 years. But in H2 you did almost in H1 you did almost 33% growth in revenue. So again, on the revenue side also, are you being conservative while guiding at 22-23%?
Yes, definitely. I think there is a lot of scope for the company to do far better in terms of revenue growth. H2 in revenue will be slightly higher compared to H1. But previously, our main product range was antihistamine. So there was a seasonality impact. But with the newer products coming in and scaling up, we are trying to have more balanced quarters. So moving forward, you will also see that each and every quarter would be more balanced in terms of the revenue as well as the margin. Definitely with the new products scaling in, the CMO piece coming in, the CMO formulations piece coming in, we are expecting a slightly higher revenue uptake as compared to 20-23%, while maintaining the healthy EBITDA margins that we are currently doing.
Okay, can you just quantify that growth number for us when it comes to revenue? So now the picture is clear that it would be upwards of 20 to 23%, but what would be that number be?
So we have always guided that we will do about 1,000 odd crores by FY27, and you can expect at least a 150 to 200 crore upside to this number.
All right. Well, Saloni, let's talk about the CDMO and the CMO space as well a little bit, because from what we understand is that you will probably start seeing some traction in terms of, registering revenues from those segments in the third quarter. Can you give us some more updates around that particular segment, and as well as what this particular segment could look like for you guys maybe 2 or 3 years down the line?
So yes, we are seeing good traction in the CMO space. That's because we already have a legacy of 38 years in terms of quality, the regulatory compliance, the statutory compliance the company has. We have US FDA approval in place, which also helps penetration in regulated markets. One of our key CMO opportunities, which is with a European company called DSM Firmenich, we have already started seeing commercial transactions from Q3. So you can expect a good revenue generation coming in from Q4 of this year itself. We also have 2-3 launches which will come up in Q1, Q2 of the next financial year, which will start contributing to the revenue. So overall expectation is by FY27, CMO, CDMO should contribute closer to 20% of the total revenue, if not more.
Understood. And also, Saloni, what is your plan when it comes to capex? Because your Lote Parshuram Model E has been inaugurated. Now, is there any meaningful capex that we can see in FY25?
So, yes, like you rightly said, we are very happy to announce that we have already inaugurated our Module E, which is going to be our largest production block so far in our facility. It's effectively doubling our capacity from 450 KL to 900 KL. It's a large setup, fully automized state-of-the-art block spread across 5,000 square meters. So we have already done about 125 crores of capex this year. So next year, you can expect about 100 crores of capex. I feel the majority of the capex has already been done in this year. And with Module E, we can reach that 1,000 crore mark with the existing capacity what we have. But 100 crores you can expect in the next year, mainly for debottlenecking and refurbishment of the existing blocks. And Ambernath site, what we are setting up now for contract manufacturing in the finished formulation space, there we'll have to do some capex. So about 125 odd crores this year and 100 crores next year.
All right, Saloni, we leave it at that. Thank you so much for joining us and giving us more insight with respect to your business as well as what we can expect going forward. Again, look forward to touch base with you once again over the next few weeks and quarters. Thank you so much for joining us.
Thank you so much for having me. Thank you.
All right, so there you have it. That's the management of Supriya Life Sciences telling us about what's in store. But on that note, we are completely out of time on this edition of KYC. Don't go anywhere. Lots more lined up. On the other side, you're watching NDTV Profit.